Now, still on the streak, Bank of America's third quarter profit dropped as a result of paying consumers extra to keep their accounts, but the company's trading and investment banking helped it surpass forecasts. As growing consumer confidence encouraged them to issue more debt and equity, investment banking fees spiked by 18% from the previous year to $1.4 billion. Now, for more on these stories, we're joined by Head of Investment at Sankore Global Investments, Aluyi. Good morning to you. It's great to have you on the show. How are you today?
Thanks for having me. I'm well.
Most welcome. Well, let's begin with Bank of America's earnings beating. Of course, we know that there was also a third quarter profit drop.
Yeah.
What can we make of this and what led to these earnings?
Yeah, so if you look across the banks which have essentially kicked off Q3 earnings, what you're seeing basically is really weaker performance, right? If you look at it on the strength of it, we're seeing performance that is weaker if you compare to a year ago. However, we're seeing performance that is better than the market had anticipated, right? In terms of the sort of estimates that the market was expecting, the performance that we have seen is looking better than what the market had expected. So we had seen some sort of downward revision in terms of estimates leading to the Q3, earnings season. So that has created what you might describe, in my opinion, really as some kind of, false, positive sentiment, really, because if you look at the results, like I said, a lot of the numbers are down. So if you look at revenue for Bank of America, really rose less than 1%, right? If you then look at, profitability was down about 2%. If you also for Bank of America, for JP Morgan, for all of the banks that have released, if you look at the results in terms of a reflection of their core banking, which is their net interest income, it's been flattish, really. In fact, for a number of them, that number has come down. And that is what the core banking is, really. Your net interest income really is the difference between what you get, from sweating the funds that you get from customers as against the rates that you are offering to them. So that's what the core banking is. If you look at that portion of those results, they're not looking too good. However, you've seen very significant support from, Wall Street, really, investment banking, fixed income trading, equities trading, and all of that. That's the major thing that has really supported the results that we've seen for a lot of the banks in this Q3.
So we don't want any false hopes here. If we look at, we've seen similar gains with competitor banks. If we look at JP Morgan Chase, Goldman Sachs, Citigroup, which we are going to discuss shortly. What does this signify in relation to the wider investment banking climate as we speak?
It just basically tells you that area is beginning to pick up. This is really the second quarter where investment banking is really supporting, those banks. If you look at last year, it was really down because there was not much that was going on. But as interest rates start to kind of recede and investment banking activities continue to improve. If you also look at the market in itself, the Wall Street, and you look at the US equities, it's really done very strongly this year as well. So that has proven to be very, very supportive for the banks, and that is likely to continue into next year. But the concern really is around core banking. I think the issue again is that we're coming from a period where interest rates were really, really high. Ordinarily, that should serve to be supportive for the banks, but you then have to grapple with pricing from the customer side. So obviously customers are demanding for higher rates and all of that. So it tends to also be, shrink the sort of margin that the banks are able to make. So it's a fine balancing act for the bank. Nevertheless, that is something that they should be able to make significant, funds or money from. So, but again, I think thankfully, Wall Street activity is really proving to come to the rescue for them.
Right, absolutely. But in light of all this, is there an expectation, you spoke about interest income earlier, is there an expectation that we'll see it surge for Bank of America in the, near future?
Yes. So, just looking at that, particularly because we're seeing interest rates beginning to come off, that should provide some reprieve for the bank, and it's also looking to grow its loan book as well. So as it continues to do that, that should provide a situation where it's able to increase that net interest income element of its revenue, and that's part of the thing that puts it on a sustainable path really going forward. But I think that as the economy sort of continues to improve, as interest rates, kind of come off a bit, consumers spend more, that should provide that impetus for that line item for Bank of America to really grow.
Right, got it. Well, let's look at Citigroup now. Also bidding estimates, but with what you said right now, we need to manage expectations and really, really look at those numbers. If we look at consumer behavior generally, how much of this is influencing the performance of these banks?
Well, because these banks are essentially lending is a significant portion of their business. So when consumers are stressed or strained, if you will, it tends to have an impact on how much they're able to do, and obviously by extension has an impact on how much the bank is also able to produce. So like I said earlier, as monetary policy becomes sort of loose, it should provide an impetus for consumers, and not just consumers alone, businesses to spend more, to access more funding, and that certainly increases the kind of business that the bank does, and also by extension the level of profitability. I'm basically looking to see an improvement in that core banking activity, that net interest income. That needs to improve, and I think it should as interest rates become easier, really.
But if we look at Federal Reserve interest rate cuts, for instance, for last month, surely this should open up, a space for more deals and initial public offerings, right?
Absolutely.
Am I wrong?
Absolutely. So what this would do is that support that we're seeing from Wall Street to these banks will continue, right? Deal making is just even actually recovering. So we think that investment banking activity will continue to surge. If you look through those results, if you look at, JP, Citi, Goldman, investment banking essentially, was a major contributor, contributed at least between 18 to 30% of revenue, which is really, really strong. And that grew very, very strongly. So we expect that as interest rates become easier, as deal making sort of resumes on Wall Street, that trajectory that we've seen will certainly likely be sustained.
Oh, absolutely. Well, let's look next at aviation, where we have Boeing going into a $10 billion credit agreement with banks. What can we make of this? It's
been a very rough patch for Boeing, really, with all of the issues, particularly with its 737 MAX, which basically that 737 line has been, the best seller for it. It's sort of like bread and butter for them, really. So that's a major issue. And obviously with all the strikes and all of that. So they're really bogged down with all kinds of issues. So any attempt to get a bit more funding is something great for them. Buys them a bit more time, helps them to re-strategize and refocus on the market. Suffice it to mention that all of the issues that Boeing has had over the last couple of years has created, some kind of gap between it and Airbus. Before now, they've been neck on neck, but these issues have kind of allowed Airbus to pull away. So I think any move right now that allows Boeing to sort of claw back at market share is a welcome development, really.
Do you believe there's a chance, given perception issues, that they will, fight the good fight and, get back neck on neck, because that's really what it's all about, right?
Absolutely. It certainly would take some time, because the sort of damage we're looking at is reputational,
Yeah.
So, and it certainly takes quite some time to repair that sort of damage. But I have absolutely no doubt that it's something that can be done. It certainly would take some time. Maybe that sort of gap, or, the sort of parity that they have with Airbus might really never be restored. But I think that Boeing certainly will be able to claw back some market share. It will take some time.
Yeah, we can see them put in the effort as well, to be quite fair. Well, let's look finally at the ECB, which is set to cut rates. The meeting is tomorrow.
Yeah.
What are the expectations there in terms of what factors are driving this decision?
Yeah, so if you look at it very critically, so rising from the September meeting where they cut rates, the president of the ECB, Christine Lagarde, had essentially got it to the fact that, there wasn't a set path. They were going to, basically look at the data. And then inflation data for September comes out, and then that tone kind of changes, because obviously that, inflation data dropped to 1.8% for the Eurozone, lower than the 2% target. You also look at core inflation that dropped to about 2.7%. It's lowest in about 2 years. So the tone for the ECB then started to change. So you had, ECB members now beginning to say that, certainly a rate cut is certainly on the table in October. In fact, some of its most hawkish members are now saying, have been seen to, allude to the fact that they are probably going to consider rate cuts in October. So it's looking like the ECB is tilting more towards that rate cut in October. But I'm thinking that, they might want to consider a pause, considering the fact that they've done 50 basis points, 2 back-to-back rate cuts. You have to consider the fact that that's just one inflation reading. You have to look at a couple more inflation readings. Also, there's an election in the US that's coming up. You want to see how that swings and get a sense of how things will pan out on that front. But I think that there's a bit of pressure considering the fact that the Fed had done the 50 basis points in September. The market is also expecting that the ECB will cut. As a matter of fact, after the meeting in September, the expectation that the market was that ECB was going to cut was around 33%. Now that's about 99%. So all of that data that has come out has really kind of pushed the market to believe this. And that's kind of, I think, swaying the ECB. But I think that them holding off and seeing how things pan out, particularly with the whole geopolitical situation in the Middle East, with US elections coming up, there's another meeting in December where they can actually go ahead and cut rates if the need does arise at that point. But it seems like the market is sort of tilting and guiding the ECB towards a cut tomorrow.
So you reckon there might be a pause?
I think there should be a pause.
Okay.
We've had 2 25 basis points cuts back to back. The reason the sentiment is shifting is one data point, and I don't think that's strong enough for them to, just go ahead and cut. I think they should hold off a bit. There are a couple of events that I think need to unfold. The Fed is also going to have a meeting in November. Elections coming up in November. I think they should hold off and see how things pan out on that front. They reconvene again in December. If the need is there, they can certainly go ahead and do it 25 basis points or even more if that need does arise.
Right. Well, it's certainly very tough decisions to make based on incoming data. If we look at the Eurozone data, worsened quite a bit. So, not the best decisions to make. But first, thank you so much for joining us. I've been chatting with Aluyi, who is the head of investments at Sankara Global Investments. We'll see you again very soon.